You cannot print additional gold, you have to mine it. So gold is an obvious asset which has long-term stability.
I'm here with John Kaiser. John, thanks for joining us today.
It's a pleasure to be here.
For the benefit of our new viewers, can you give us a brief introduction to yourself?
Okay, I'm John Kaiser. I run Kaiser Research Online. We cover the 1,500 or so Canadian listed resource sector companies, juniors and seniors.
John, in your talk today, you talked about gold's strong run in the early part of 2016. Do you think it's sustainable?
Well, in the last 2 years, we have had good gold rallies in the first quarter, and that got people hopeful that at least we'd have a bifurcation of the better companies carrying on. But shortly after PDAC in March, the gold rally failed in both the last 2 years, and we ended up with a year that was more miserable than the past one. So there is concern that this year, this is again a sucker rally in gold. It might touch 1,400 and fail. But this time there's a little bit of a different driver for the move in the price of gold. This time we are seeing the GLD and all the other gold ETFs actually increase. Since the start of the year, it's increased by about 4.5 million ounces, 20%. So investors are buying the ETF, which is soaking up physical gold. The thing that's a bit worrisome is in Asia, China, and India, gold is trading at a $25 to $30 discount per ounce from what the price is in the West. So the fundamental long-term demand is not there. ETFs can be sold overnight. Now, what's driving the interest is the concern that now we are looking at deflation. We're looking at something unheard of, negative interest rates. So no longer do you have your safe money in the bank earning 0.5% or 0.25%, next to nothing. Now we're actually going to be taxed on our savings. So in Sweden and Europe, you're already losing 0.5%. Maybe it goes to 1%. In the United States, it has not yet happened, but we're pretty close. So there's now this concern, I don't want my money to erode over time, get less and less and less. Maybe I should put it into a safe haven. So gold is an obvious asset which has long-term stability. But the paradox about it is volatile. It swings 20% a year. So there's a bit of a perversity in piling into gold as a safe haven to protect yourself against negative interest rates. And that's why I'm a bit worried that if the rally stalls, we'll see a reversal of that.
You talk about that perversity of gold being a safe haven, but that is the general impression of gold price. Expand a little bit on that, if you would.
Well, gold is a physical asset that's mined from the earth. It's in essence stored energy. You cannot print additional gold. You have to mine it. There's been 5.7 billion ounces mined in the course of the last 10,000 years, and that's the low-hanging fruit. Whatever gold's left in the ground is going to cost more to get out. So if you want more gold, you're going to have to dig it up at ever higher cost, and that's not going to happen unless the price goes up. So I'm a long-term bull on gold. I think it should be in the $1,200 to $1,400 range. $1,200 to $1,400 over the next couple of years. If the global economy gets on track, we are facing a period of geopolitical instability. We have the phenomenon of Donald Trump potentially becoming president, and nobody knows what exactly it is that he does believe, and that could cause gold to be owned as a kind of a geopolitical safe haven, not as protection against negative interest rates, but just to own something that's completely independent of all the other asset structures, all the title systems in the world. That's what gold's best value is, as a long-term hedge against things you don't actually want to happen.
John, thanks so much for taking the time to speak with us today.
You're welcome. It's a pleasure.
Reporting from PDAC 2016, I'm Angela Harmantis for SmallCapPower.